Hi guys, welcome to Enriching Lives, where we talk about life skills, career, wealth management, personality enhancement, job vacancies, and a lot more. If this interests you, do consider subscribing our channel. Your support means a lot to us. So you are watching Financial Management Series session number 3. And in the previous sessions, I have talked about the concept of inflation, the credit card and EMI trap, and the basics of wealth management. I'll drop the link in the description below so that you can watch out the first 2 sessions as well. Well, we all know to build a world-class building, the foundation has to be strong enough. Similarly, to generate immense wealth and to build a legacy, your foundation or your basics have to be strong enough. In this entire series, I will try my level best to make your foundation of financial knowledge really strong. I'm sure the series will be really helpful for all of you. Do watch this video till end. I'm sure you will get a lot of learnings and key takeaways on how to build your portfolio. So without further ado, let's get started. Let me share an interesting fact with all of you. The market price of MRF tire in 1968 was rupees 17. And do you have any idea what is its market price today? Well, let me tell you, today's price is 81,156. I'm sure you all must be shocked. So it is nearly 5,000 times. So people who have just bought it and kept it for long-term investments, well, you can really understand what kind of money they have made. Now, MRF, as we all know, is the largest tire manufacturing firm in India, MRF or the Madras Tire Factory. Right? So there are a lot of examples which I can give you right now wherein you can see this story of immense wealth being generated out there. But then let me also tell you that to generate wealth of this kind, you should have pretty good knowledge about the stock markets. You should have a knowledge of the fundamentals. How does the stock market work? What are the different concepts that are prevalent here? And how do you actually pick a stock that is going to become a multi-bagger? Before talking about all these things in detail, let me first burst certain myths about stock market. So I want to start with a clean slate, because I know many of you might be having a lot of presumptions and notions about stock market, which you might have heard, from your friends or people around you. So we all have heard this thing, that stock market is gambling, right? So you must have heard this. Do not put your money in stock market. It is a kind of gamble. Let me tell you, it is gambling for those who do not do any kind of research, who just work on the news and the tips that they get, and who just believe in trading. They just keep buying and selling without even knowing what kind of stock they are picking, what is the fundamentals of that company, what does that company really do, what is the kind of management the company is having, what has been its track record if I talk about the revenue, the top line and bottom line growth. So they do not do any kind of research. They just put their money blindly for trading purpose. So yes, if you do this, this is pure gambling. So you are just buying something about which you really do not have an idea. You are just trying to play with your luck. If you find people like this, that they say that stock market is a gambling place, yes, a lot of people might do that. But we are not here for this purpose. So we would try to understand what is the difference between gambling or trading and investment. So here I'm talking about a pretty good amount of money that could be generated through investment. As I gave you an example of MRF tire, there are a lot of companies that have really made the investors billionaires and millionaires. So let's talk about that. So it's a myth, this is a place to gamble. Well, it is for some, but we are pretty sure that we are not here for that. The second myth that a lot of people have is that stock market is very risky. So there would be people who will warn you, do not invest, you'll burn your hands, you will lose out your hard-earned money, this is not a place for you. I know people who have made such huge losses, so you will come across a lot of people who talk like this about the stock market. Well, let me tell you, stock market is risky. I am not denying the fact, but there is a difference between taking risk and taking a calculated risk. Now, what I mean by calculated risk is when you know what kind of stocks you are putting money into. When you are well educated and still you take a risk, that is a calculated risk. So you know where you are heading. Also, you can minimize your risk by diversifying your portfolio. Well, we all know this saying that you should never put all your eggs in one basket, right? So when you try to build a portfolio where you have a proper asset allocation, so there are some products that carry high risk. On the other hand, there would be some products that are really not risky. So when you have a portfolio like this, wherein you try to balance out the risk that is associated with each product, so this is how you can minimize your risk. Yes, it do becomes risky when you just start buying stocks and the market is gaining momentum and you just become a part of the buying spree. Okay, so you are actually a part of a roller coaster when you see that, it's just moving upwards, and people just buy in that frenzy, in that momentum, in that phase of excitement. And when the market is euphoric, wherein people are really not able to understand and analyze what are they buying actually, then yes, you are having a big risk in your life. Okay, so do not be a part of this momentum game, because that is very speculative, and here you do not really buy on the basis of fundamentals. You really buy on the basis of tips that you get from the people, or the insider information, or you also get carried away with the emotions and the sentiments of the market. So when you buy during this period with this frame of mind, yes, you are actually taking a lot of risk, because you never know when is this momentum going to slow down, and in no time your money will be wiped out. So you will not be able to exit at a point at a particular time when the market is going to slip down. So if you are a part of momentum, if you want to be a part of this buying spree, then always remember you are actually taking big risk, because this is not based on the strong fundamentals of a company. This is purely based on the trends and the projections that are driving the markets at a particular situation. So be cautious if you are buying under the influence of the market sentiments or the momentum that is carrying the market to newer heights. So yes, it can be risky if it is not a calculated one. I hope the concept of risk and calculated risk is pretty clear to you. So this is a myth. Yes, market is risky, but it's up to you what kind of risk you are taking, what kind of stocks you are picking, and what is the basis of selecting the stocks. Now, before moving deep into what kind of stocks you should pick or how to maximize your returns and wealth, I would quickly like to tell you something about the stock exchanges, so that even the beginners who are watching this video can understand what is exactly meant by these terms. I'll just give you a very simple example. Now, we all go to the vegetable markets, okay, where vegetable and fruits are sold. Now, what happens there? So it is a place for buyers and sellers. So let's say you went to buy some tomatoes. Okay, now there's a seller of tomatoes. Have you seen those sellers? They keep on reiterating the price of a particular vegetable. They keep on shouting a particular price. So what are they trying to tell you? They are trying to tell all the buyers that I am selling the tomatoes at this price. Now, what do you do actually? So when you reach that place, so you tell him that the tomatoes are too costly, so you lower the rate. So let's say he offers you 40 rupees kg and you say no, it's too costly, lower it down to 32 rupees, and let's say he settles at 35. So this is called as negotiation. So what happened actually here? The buyer and the seller, they had different prices in their mind. The seller wants to sell at 40 and you want to buy at 32. So you both reach at a mid price, which is 35. So in this way, you get the tomatoes and he receives 35 rupees for those tomatoes. What actually happened here? You both negotiated, right? And you arrived at a common price. So that became the selling price of tomatoes. Okay, so there's a buyer's price and there is a seller's price, and the price which is agreed by both the parties, it becomes the market price of that vegetable. Similar is the case with stock market as well. Well, here earlier when there were few companies which were listed and there were few buyers and sellers, yes, we had physical markets also where shares of different companies were being bought and sold. But with the advent of technology and the number of companies and the buyers sellers increasing at large, so everything has shifted to an online platform, or you can say digital platform. So now you do not have the physical certificates of shares with you which were given earlier. Now what we have is the electronic form, so we can save it electronically. So that has reduced a lot of paperwork and it became hassle free, and it is very fast and quick. So the place where this buying and selling takes place is called the stock exchange. Okay, now in India we have two main stock exchanges, the Bombay Stock Exchange and the National Stock Exchange. For the companies to sell their shares, what they need to do is they need to get themselves listed on these stock exchanges. Then only the investors would come to know, right? The shares of so and so companies are floated in the market. So for investors to have knowledge about which shares you can buy, the company has to list their shares on the stock exchanges. So Bombay Stock Exchange is at Bombay and the National Stock Exchange is located at Delhi. Now there are a lot of companies that are listed on these two exchanges. So if we want to know at any point of time how the market is performing, what is the overall trend of the market, so for that an index is formed for both the exchanges. This index is an indicator of how the market is performing. So if I talk about the Bombay Stock Exchange, well, the index for Bombay Stock Exchange is called Sensex. Sensex stands for sensitive index. At any given point of time, if you want to know how the companies of Bombay Stock Exchange are performing or the overall market trend of Bombay Stock Exchange, well, you can have a look at the Sensex. Now, how these companies are chosen? Sensex comprises of 30 companies from Bombay Stock Exchange. These 30 companies are chosen on the basis of their market capitalization. Now this brings us to another term, which is market capitalization. Let's have a look at that. If I own a company ABC and I want to raise funds, okay, now what I can do is I have two options. Either I can raise the funds through debt or through equity. If I go for debt option, well, in that case either I can go for loan or I can issue bonds and debentures, right? But on the other hand, if I go for equity, so in this case I float shares of my company into the market. Now with this, what happens when you buy a share, you also hold a portion of ownership into my company. So you own a small part of my company, which means that whatever happens, either the profit or the loss, we will bear it together. Okay, let's say I float 1000 shares and the market price of these shares is 50 rupees. So the market capitalization is the number of shares multiplied by the price of one share, which means that the market capitalization of my company would be 50 into 1000, which is equal to 50,000. Okay, as simple as that. So the number of shares multiplied by market price of one share, that is the market capitalization of any company at a given point of time. As you can understand from this, the market price of the shares keep on fluctuating. So will be market capitalization, because it depends on market price. When the market price of a company go up, its market capitalization will increase, and if the market price comes down, the market capitalization of that company will decrease. And once the market capitalization of a particular company decreases substantially, it can be out of the Sensex and some other company could be a part of Sensex. So the composition of Sensex is based purely upon market capitalization. I hope the concept of market capitalization and Sensex is pretty clear to all of you. Now similarly, if I talk about the National Stock Exchange, so the index which is formed by picking the companies from National Stock Exchange is called Nifty. Now it has got 50 companies in it. So you can remember it in this way as, Nifty 50. So Nifty has 50 companies and Sensex consists of 30 companies. This is all for today. In my next video, I am going to talk about certain key concepts and indicators that helps us to understand how the market is performing and how to pick the right stocks. Talk about earning per shares, the PE ratio, fundamental and technical analysis, and a lot more. If you liked it, do smash the like button as it motivates me to create more of such content. I'll see you soon with yet another video. Till then, you take care of yourselves. Bye-bye.